Bonds used to be the safe but boring part of your portfolio. Well, this week we're going to talk about if bonds are making a comeback or not here on Phil's Tax Hacks and Other Retirement Facts. Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome into the podcast. Thanks for hanging out with Phil and I as we talk investing, finance, and retirement. And Phil, are bonds back? And I don't mean James Bond or Barry Bonds, at least or at this minute. But this might feel late because the bond rates have been up for the last couple of years, and now they tick down just a quarter point. But really, basically, I wanted to have this conversation because I've got some quotes recently from a few larger publications talking about bonds, and I wanted to get your reaction to them. So how you doing this week?
Doing good.
Yeah, good. So have you seen some of these? We've got one from U.S. Bank, and I will throw it up on the screen for folks here to check this out. But let me give you this quote, and you tell me what you think. So to understand why opportunity exists in bonds in the second half of 2025, it's important to remember where bonds come from. A bond can deliver a return to its owner from two sources: interest payments, known as coupons, whose rate, is set at the time the bond is issued, and then changes in the price of the bond as it trades in the market. That's from U.S. Bank. And we'll throw that up again for people to read that while we're talking here. But can you break down, I guess, why bonds have a misunderstanding? And, are they more than just the boring, safe thing? And what's your thoughts on them currently in 2025?
Yeah. So, bonds often have been thought of, that safe part of your portfolio. Okay? And to your point, the boring part. And in theory, yeah, they are. It's a bond, you're basically lending money to a company. They're paying interest, right? So it's kind of like CD at a bank. Obviously, no FDIC insurance, a lot of differences, but in general concept, that's what's going on. So yeah, it's boring. You're getting this monthly or quarterly coupon, whatever it happens to be, this interest that they're paying you. So from that side of it, it can be boring. It's just paying a fixed interest rate over its life. The other side of a bond, though, is the valuation. And that's the part that I think most people kind of forgot about. Because the valuation is going to be set based on the market, what somebody's going to buy your bond for, which ultimately is going to be dependent upon, number one, the interest rate your bond's paying and what the market interest rate is today. So historically, yeah, bonds have been pretty boring, pretty stable. Actually, 15 years ago or so, over that period of time, bond values actually increased, which was kind of an odd thing. Usually that doesn't happen. But the reason for that is that bonds that were issued, say, 15 years ago had a much higher interest rate. So as interest rates fell, well, your bond that had this higher rate was actually worth more. Somebody's going to pay you more than face value. They're going to give you what's called a premium.
Right.
Well, then we went through the whole 2022 timeframe where all of a sudden interest rates started to spike. The Fed raised interest rates and inflation was happening. Well, just the opposite happens in that case, and this is the part of the valuation of bonds that people at that point probably got caught by. And it's not new. It's happened several times, maybe not to that extent, whereas interest rates started to rise. Well, all of a sudden, your bonds now that were issued at a lower than market value interest rate in current markets were worth less. So they were selling at a discount. Somebody's not going to give you the full face value. So that side of a bond, though, is just based on the market. It really only comes into play if you're buying or selling a bond before it matures.
Right. And typically you're going to hang on to those, right? Typically for most investors, right?
It depends on how you're investing in your portfolio.
Okay.
If you are buying truly an individual bond, then yeah, you would probably hold that bond to maturity. And as long as you do, you're going to get your monthly, quarterly interest, and you're going to get paid the principal at the end of the maturity, provided the company is still there and viable.
Good quality bond and all that stuff. Yeah.
That's the other side of the equation too that plays into valuation and interest rate is the rating of the underlying borrower, the company or government, whatever it happens to be. So,
right. Yeah, as a quality bond versus not. Right.
Right. So at a high level, that's kind of where they're at. So are they back in style? Well, this is one of those things like any investment, right? Bonds have had a really good year Why? Because interest rates have leveled off and actually the Fed just cut rates, right? So now bond valuations are starting to tick back up because you might have had a bond issued 2, 3, 4 years ago, 2, 3 years ago now, I guess in 2022 or after.
2022, yeah. Uh-huh.
That was at a higher interest rate. Well, if your bond has a higher rate than what current market values are, well, you're going to start to see just the opposite effect happen where the valuation goes up. So, I mean, is it a good time? It comes back to market timing, right? Is now a great time to jump in because they've done really well? Okay, yes, they have done well this year, but you have to look at the long-term big picture.
Gotcha.
You know, I mean, if you look at it over an extended period of time, bringing in both the highs and lows, you know, I mean, you can't just get focused on what's going on today. So,
yeah, okay.
So I wouldn't say no, bonds are back, you know, time to jump into bonds. Your time, it's market timing. You know, if bonds fit into your portfolio based on risk and what you're trying to do, that didn't change from before. You know, maybe it was a little bit more of a challenge before because interest rates were lower. So if any opportunity exists, that might be the opportunity is, hey, you can lock in, you know, potentially some higher interest rate bonds today as interest rates start to fall.
Gotcha. Okay. So yeah, and there's a big difference obviously between bond funds and just a bond.
Well, yeah. So bond funds, the challenge there is that like any fund, mutual fund, you know, or ETF, the underlying holdings can change as investors buy and sell. You know, so it's not typical, especially with a mutual fund, that mutual fund is going to hold bonds to the full maturity. There's a portion of their portfolio that they would, but as there is churn happening, meaning investors are, you know, buying and selling, well, they're having to generate, that fund is having to generate cash flow to satisfy either the redemption or reinvest back in if people invest in.
Gotcha.
So they're buying and selling bonds. And they're going to see more of that volatility, or I shouldn't see more of it because any bond will see it, but they're going to realize that volatility more because great example in 2022, if you as an investor in a bond mutual fund saw the fund dropping and then wanted out, well, you force the hand of the mutual fund advisor and they're having to sell bonds worth less money now to satisfy your redemption.
Gotcha. Okay.
And that's always the challenge in investing in mutual funds is that the current investors are actually bearing the action or the results of the actions of those investors that are either leaving or coming. They're causing the managers, they're kind of forcing the hand of that manager.
Let me throw up another one here and we'll talk about this one as well. It says, and we'll throw the graphic up so people can read along here, but ignore the market for 30-year bonds at your own peril. Pension funds may be playing an important role by reducing demand now, but they are also awakening markets from a decades-long cognitive dissonance. There are reasons to worry, not only that rates aren't going back down, but that they may actually rise. Now, there's a lot of jargon in there, and as a financial advisor made this quote, we'll just throw it up there, but it's sometimes like somebody will hear that or read that and go, what the heck does that even mean?
Yeah,
right?
Yeah. Long-term investors like pension funds, right? I mean, they obviously don't have a time horizon, at least to the extent or the same time horizon that you or I do, right?
Okay,
I mean,
right.
We're planning for 25, 30-year retirement, whatever it happens to be. I mean, pension funds are a fund that hopefully continues for the life of the pension owners behind it. You know, so I mean, it's not this defined shorter life expectancy, so to speak. So they've got a longer term runway, so to speak.
Mm-hmm.
So yeah, for them, that longer term bond might come into play. But I mean, the reality is with pension funds, I mean, they're looking for yield, you know, generating revenue for their fund to be able to pay those monthly pensions.
Right.
And, you know, again, stepping back 10 years or so ago, I mean, these long-term bonds were paying very, very little interest rate. I mean, you know, think of it. What were you getting in the bank back then? 0.005% or some crazy
right. Yeah. Terrible. Yeah.
nominal number. So they started to maybe shorten the term on those because they didn't want to get locked into these very low interest rate long-term bonds. And that's where more of the danger lies because you've got to hold that bond for that whole maturity before you get your principal back. So if you did want to sell, you know, early, you're at the market's whim, basically, of what's going on with the interest rates. Now that we've had a higher interest rate, if a company's issuing a 30-year bond today, well, they're issuing it at a much higher rate. So it may be good to lock those in. Although looking forward at the economy, there's all sorts of economists and predictions of where do we go from here. Right now, yeah, we are in an interest rate lowering environment. I mean, the Feds have started to lower rates, but that's the short-term rate. Ultimately for a 30-year bond, and that's why as you see some of this happen, it doesn't change the 30-year bond
Gotcha.
right now.
Okay.
So 30-year bonds are really trying to price in what they think that short-term rate's going to be in the future.
So the news headlines we often see when we're talking about the Fed doing this or that is the short term.
Oh yeah, it's the short term. So that's why when you get to, why the Fed just lowered rates, why didn't the mortgage rates drop immediately? Or we've actually had it where the Fed lowered rates and mortgage rates went up.
Okay.
Well, because they're not the same term,
Gotcha.
and they do over time, they start to converge. If interest rates, the short-term rates continually drop, well, you're going to see the long-term rates drop too, because it's looking for that longer-term trend.
Okay.
So
yeah, and
that's the worry today is looking at where we're at today. In the long-term rates have changed dramatically as interest rates rose, but as we start to see the tick down, we haven't seen much change in that 30-year rate yet. Now, if rates do continue to drop, yeah, we might eventually start to see some of that decline. So
are you putting bonds in people's portfolios right now, like a 40-year-old or a 60-year-old, or are you shying away from those unless they ask about them, or is it really case-by-case specific?
It's really case by case. We do in our portfolios build in some fixed income bond type exposure. But if you're thinking of, the more risk off side of the equation, how do you get a lower volatility type portfolio? Bonds is one side of the equation. There's many other aspects or investment vehicles you can use today.
Okay.
So bonds aren't the only thing. It used to be
the only safe place to go. Yeah.
Back to the 60-40 portfolio was 60% stock, 40% bond. That's,
gotcha. Yeah.
Kind of what it used to be. Well, in today's environment, you might be trying to target that 60-40 volatility, in risk profile, but the 40% might not be 100% just in bonds. So,
okay. Well, let's throw up one last one here from Fidelity, and we'll talk about that real quick, and then we'll wrap up. So this one from Fidelity says, if you are looking for income from individual bonds, current yields near multi-decade highs in longer-term bonds can offer an opportunity. And if you are considering bond funds or ETFs to diversify your portfolio, Fidelity's bond managers believe that a combination of high current yields and interest rates that are expected to gradually fall later this year is creating an attractive total return opportunity for bond investors in the months ahead. So that's from Fidelity. So when you're building that portfolio, again, right, when you're seeing these kind of trends, is that something that you're just kind of watching, or is this just kind of again, wait and see and react after the fact?
Well, no, so like we were mentioning before, as they're talking about the long-term bonds are at the higher rates today. So yeah, it might be time to lock in some of those rates.
Okay.
You have less downside risk exposure at this point because you're locking in a bond issued in a higher interest rate environment. As interest rates fall, that's actually a good thing for that bond. So then the risk side of that equation, if interest rates do fall and then come back up, well, they've got to get above what the rate was in that long-term bond that you have today.
Gotcha.
So you have less volatility risk. So that's why, over the last year or so, 18 months, you've probably seen portfolios start to shift more to a longer term type of bond because they can capture that, hold on to it, and not have as much exposure versus like in 2022, that was those terms were getting, the horizon was getting shortened. They were trying to lessen their exposure. So they were going much shorter term bonds. So they didn't have to worry about the volatility as much, or the volatility wouldn't affect them as much. So that's if you hold the individual bond. The challenge, though, as they're mentioning, is holding that bond mutual fund. It's not the same thing because you don't really know what underlying bonds that they hold. And that's always the challenge with the mutual fund is you can't look inside and see, well, here is the actual bond holdings, or here are the bond holdings. Just like a stock mutual fund, you can't look in the fund and see all the stock holdings that they have. They might tell you what their top 10 are.
Right.
There's a lot of unknowns and exposures built into those bond mutual funds. So just be cautious, because their hands are going to get forced by the underlying investor is what it comes down to as they're buying and selling.
So at the end of the day, it's like anything else, right? Bonds can provide some income, some balance, a little bit of peace of mind potentially, but it's not a one size fits all product, just like any other product, right? So
not at all. Yeah, I mean, so bonds, are they the right fit? I mean, they could be, definitely part of an overall portfolio, especially as you get to a more conservative portfolio, and maybe those bonds are a little bit shorter term, so you don't have the volatility.
Right.
But like anything, don't get locked into, well, you got to have bonds. Bonds, they have to be in the portfolio and they've got to be at this percentage. I mean, you talked earlier about, what percentage bonds should you have at, these various ages. I mean, there's rules of thumb out there. One of them, used to be, well, if you take your age or 100 minus your age, well, that gave you the percentage of equity you should have in your portfolio.
Right.
Think of it the other way. The age was the bond percentage. Well, okay, so as you age, the bigger percentage of bonds that you should have in your portfolio. Again, very high level in theory, kind of makes sense. At the end of the day, you have to understand what is that trying to do? It's really trying to lessen volatility, and make a more conservative portfolio. So don't get caught in, well, bonds are the only thing for that more conservative side of the portfolio, because there are other options and ways to structure a portfolio today that don't have to have all of that just in bonds.
Gotcha.
So,
yeah. And that was really the point of the conversation. And I forgot this was our 300th episode. So unfortunately we picked bonds, which maybe isn't the sexiest thing in the world, but so happy 300. So, to you, my friend. But yeah, look, at the end of the day, it's always, it's always an individual, puzzle building application when trying to get the right portfolio put together and the pieces that you might need. We see all the headlines and we want to go, oh, should I get into some of that or should I get into some of that? And that's why you got to have a good strategy and an evaluation of what you have and what you need for what you're trying to accomplish. So get yourself on the calendar, reach out to Phil if you got some questions, need some help, or talk with a qualified financial professional in your area. Of course, Phil is a CPA and a personal financial specialist and can give you some help if you need some. So find him online at philstaxhacks.com. We'll put links in the show descriptions below, so you can just click on that to get started. And we also have the blueprint there. If you want to check that out, we'll have that pop up here in a second, and you can get started that way as well. Have yourself a good week. We'll see you next time here on Phil's Tax Hacks and other retirement facts.
The Tax Smart Retiree is your comprehensive guide to mastering tax efficiency for a flourishing retirement. You will find indispensable advice and actionable strategies designed to enhance tax savings, maximize Social Security benefits, protect against market volatility, and develop a customized retirement plan. To get your free ebook, click the link in the show notes of today's episode and download your copy of The Tax Smart Retiree right now.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.